Hello, everyone. Again, I'm Cathie Wood, CEO, CIO of ARK Invest, and the market's getting a little jittery, and so I thought that we would weigh in and give you our point of view. So the way we do this, as we have in the past, we'll talk about fiscal policy, monetary policy, market signals, economic indicators, and we'll talk a little bit about innovation. I think we'll save a lot of the innovation discussion until next week, which is the end of the earnings season. And it has been an exciting season indeed. So fiscal policy, we're in a bit of gridlock here. I think that's unnerving some in the financial markets as the payments supplementing initial unemployment claims, they have ended, or they are ending, I think, today. So lots of nervousness out there. We can also see some equivocation by some very short-term indicators that I think will move the politicians into action here. We were hoping, as you know, for a payroll tax holiday for both employers and employees. Seems like that's been nixed, and that's most unfortunate because the economy it is strong now, but these equivocations we would avoid. Businesses and consumers would get back to work. Businesses, yes, and consumers would get back to work much faster than will otherwise be the case now. As far as monetary policy, the Fed this week basically said, you know, we've got your back. We're not going to change anything we're doing. They extended some emergency funding through the end of the year, and we're seeing M2 growth still in the mid-20s% range, which is unbelievable. So what that means is the velocity of money is falling. If it weren't, we'd see GDP growth at roughly 25%. Of course, that's not happening, meaning on a year-over-year basis. That's what the Fed is trying to make happen. So the velocity of money is falling. It means that people are just, saving it. And I'll give you some statistics a little later on to validate that. So this monetary policy, while people talk about inflation as a risk, does not seem to pose a risk at the moment. And in fact, the Fed is very focused on core inflation, which was quite subdued in the last month. So fiscal policy, I think, will sort itself out, not in the way that we wanted, not in the most productive way possible, but we think something will be done. Monetary policy, no change. And so market signals. I guess in the equity market, something important did happen this week. The logistics companies broke out. Well, it was led by UPS. UPS broke out on very surprising earnings growth. Now we're getting other numbers from Amazon and other online players, which are suggesting that the sales were so much stronger than most analysts expected. So no surprise there. But usually the freight and logistics market is a leading indicator for the market as a whole, and usually is associated with a V-shaped recovery. So that all makes sense to us. What doesn't make sense is that the value space is still listing. It's still struggling. And as you know, we are always saying that a lot of companies are going to be disrupted in the financial sector, in the industrial sector, in the healthcare sector because of innovation. Now, those three sectors tend to be value sectors today. And so maybe the market is just saying, wait a minute, what is this innovation, all of this innovation going to do to these companies? Maybe that's all we're seeing right now. But I am surprised that as a part of the market recovery, that value has not really played a very big role. Maybe UPS is a leading indicator. We shall see. Or maybe UPS is now being influenced so much by the innovation that's going on, meaning it's a participant and a beneficiary of the online revolution, that it is less of a leading indicator. So stay tuned there. Another interesting market signal is the VIX. So this is the volatility index. Now, this index in the March crisis shot out on an intraday basis to an all-time high. And actually that was a good buy signal. Now it has not gone back to its lows. And it would suggest, if you, depending upon how you measure the world, that we're still in somewhat of a risk-off period. And I think that if you look at the broad-based market indices, they're flat to down, except for the NASDAQ. That is true. This is a subdued market. We have recovered from the shock, but there have been a lot of sectors not really participating that much on the upside. The other interpretation here, though, is that could it be for the first time since the tech and telecom bust, so in 20 years, that the volatility index is elevated in a risk-on environment. Now, that has not been true for the last 20 years. And because of that, most investors, whenever they hear that the VIX is at a record low or near an all-time low, they brace for a risk-off period because that's what's been happening throughout the last 20 years. Every spike in the VIX has been associated with risk-off and a tumultuous market environment. Right now, we're not at the lows, which would be around 10. We're at 25. We're not at the highs in the 80 plus range, but 25 by using history as our guide is quite a high level. And some of the innovation spaces upon which we focus seem to have been a beneficiary of volatility on the upside. Now, we have not seen this since the 90s. In the 90s, we regularly saw this, especially after 1994, 95. And of course, that culminated in, the VIX spiking to very high levels as the internet bubble was reaching all-time highs and getting ready to burst. We do not think we're in any kind of bubble right now. In fact, if anything, I see a lot of caution and fear. I see a big wall of worry. You see investors worrying about every nuance within the economic statistics. So I like the wall of worry. Using the bond market as our guide from a market signal point of view, it's very interesting. We have the 10-year Treasury bond yield back down to its closing lows of the crisis. It was around in the low 50s. On an intraday basis, we got into the 30 to 35 basis point range for the 10-year Treasury, but the close was above 50, and we're just about there again. And so many people would suggest, well, that certainly is a risk-off signal. Well, yes, it could be, but then we have some contradictions. First of all, the market itself, led by the innovation space, is up roughly 34%, or it's roughly 30%. At the same time, the yields have been coming down. And we've also seen the lower quality yield, the spread of the lower quality yielding bonds to Treasury bonds, that has narrowed, which says, okay, the risk is coming out of the market. So I'm going to lean to the stock market and the lower quality yields. in terms of saying this, we are not in a crisis here. It is simply that investors have become very comfortable with the notion that the Fed is going to take care of any problem and is going to be there from a quantitative easing point of view for a very long time. Now, there is another indicator I pay a lot of attention to, and I think it's going to be critical in the next few months. It's the dollar. The dollar does seem to be breaking down, which is good for is good for foreign markets, actually, especially emerging markets, which have a lot of dollar-denominated debt. So in a sense, that's a clue that our monetary easing is being transmitted to the rest of the world. So that's good. But it also could be an indicator that inflation is brewing. And I just gave you some reasons why I thought it wasn't. Velocity coming down being the most important. Productivity going up in a V-shaped recovery also helping. The third explanation, however, and this may be what the market's focusing on, is terms of trade. What that means, terms of trade are influenced by the fiscal and monetary policies of each country. And so when corporate tax rates or income tax rates go up or regulations go up, the terms of trade for the country raising the rates and increasing the number of regulations goes down, and with it, its currency. And it could be that the dollar is beginning to fear that we are going into a higher tax, higher regulations regime in order to, in the case of taxes, pay off the gaping deficits we are this crisis has caused. Now, that's one way to close the gaping deficit. Our preference would be rapid growth, much more rapid growth than the market now expects. Growth can heal a lot of sins. And we think that the innovation platforms upon which we focus and which have gained so much more traction than even we could have believed during this crisis, we believe these are exponential growth trends and could become an important solution to our fiscal problems. We hope that whatever the regime is after the US election, will err on the side of trying to stimulate growth through capital-friendly policies, as opposed to attack growth with capital-unfriendly policies. So now on to the economic statistics. One of the things we talked about a lot during April and May was that consumers seem to be tiptoeing back and actually taking a few more strides towards spending with each month. And lo and behold, we saw shocking increases in retail sales. I think it was 17.7% increase, something like that, in May, and then another 6% or something close to that in June. So the consumer did start to spend. But businesses were very cautious. And so we saw the biggest inventory liquidation, bigger than in 08-09, than we have had, I think, since we could be going all the way back into the 70s now. And so this idea that inventories are falling and the consumer is spending, which does not contradict what I said about velocity. The consumer is also saving a very large amount of income. So just to give you a sense of that, and we got these numbers yesterday. In June, the saving rate was still 19%. Again, that's the third highest rate on record. The revisions show now that in April, the saving rate was 34%. In May, it was 24%. In June, 19%. Before we started or into the crisis, the saving rate was at 8%. And we were already then remarking how high the saving rate was. It's fairly high compared to historical standards. So the consumer is saving, but the consumer is spending as well, just not spending all the savings. And so this inventory liquidation has gotten so much worse. And so we weren't surprised to see the industrial production numbers picking up quite dramatically. Businesses are scrambling to catch up to consumers. I think you're hearing a lot of shelves are bare. I'm hearing some of these anecdotes. And this is another stimulant to a V-shaped recovery. So while we may see some stalling out in some indicators, weekly indicators, I think the far more powerful message here is inventories have been drawn down to such a low level that if businesses don't crank up, they're going to lose business to the competition. So we saw wholesale inventories for June down 2%. The expectation there was only 0.5%. In the retail space, we saw inventories down 2.6%. This is month to month, not year over year. If you annualize these numbers, you get a sense of how dramatic these inventory declines are. The retail inventory decline in May was 6.1%. So businesses are far behind consumers. And consumer confidence indicators are suggesting that confidence is continuing to move up, maybe not dramatically. It had a nice move up and it's slowly moving up now. There are a couple of indicators that have surprised us. Housing sales on a year-over-year basis, new home sales are up 13% on a year-over-year basis. So that's out to a new high. We also saw housing new pending home sales. If you look at the Northeast, which was hit the worst by the virus, in 1 month, pending home sales went up 54%. That's not annualized. That's 1 month from May to June, 54%, on top of a 45% increase in May. So housing is on fire in the Northeast, and as it is pretty much across the country, just not as dramatically as in the U.S. So that's very reassuring. And the other thing that has changed since we were speaking to you during the crisis is we saw the used car price index as measured by Manheim crater because Hertz went bankrupt and was going to have to sell 700,000 cars into a zero demand market. Well, what's happened is, again, this is the consumer speaking pretty loudly. Consumers have decided mass transit for them is not for them right now. And they'd prefer to buy a used car, have a second or a third car if they need to go to work. So auto sales are picking up pretty nicely, but the used car market, the prices that we saw cratering in April and May have gone out to all-time highs. That's how quickly this has happened. And it also makes sense if housing sales have picked up. Let's say a family has moved from a city into the country. Typically, that means car sales will pick up accordingly. If they have one car now, they'll move to two, and so forth. So that's pretty interesting. Let's see. On the innovation front, I think analysts have been shocked at how much stronger the consumer has been. If you look at Amazon's sales, the consensus estimate was $8 billion too low for this last quarter. And if you look at Shopify's results, which gets perhaps a broader, gives us a broader look, analysts were 50% off expectations. So this notion that innovation gains traction during difficult times, it is in overdrive. And we heard PayPal this week say that it did not expect to see some of the business it is seeing now for 3 to 5 years. So those 3 to 5 year expectations have been compressed in terms of the kinds of demand they're seeing into 3 months. I guess on the advertising side, we got a number of reports that I think the most surprising disconnect for me was you had Google's search down 11%, which is that's what drives their advertising. And you had Amazon's advertising up 41%. So what we're zeroing in here on as this crisis evolves is something called social commerce. What that means, and we saw this with Pinduoduo in China, is there is some social element now taking place along with shopping. So, Instagram, you can has its own in-app stores now. Pinterest, which had a huge upside surprise today, has its own in-house stores, or so in-app stores, that is. So we're investigating this notion of how shopping is going to change. A lot of people thought in the old days wasn't so long ago, that Groupon was going to become the next commerce phase, social commerce. Instead, what we're seeing are the social networks themselves with the in-app stores creating more commerce opportunities for consumers and making it a more social experience. So it's really interesting. And we even think that this could extend into the gaming world. I know I mentioned before Epic's Fortnite starting Party Island and introducing movies and concerts. We wouldn't be surprised if they start introducing commerce opportunities there too. So stay tuned. We believe that innovation is, as I said earlier, an exciting way to get out of the mess that we're in from a fiscal policy point of view. And we hope that our government officials understand that and run with that. Okay, thanks so much. Bye.